Welcome to the AI Brief from the YPO Technology Network. I'm Stephen Forte. Last week, a very old, very large technology company lost about $68 billion of market value in a single day. The miss that set it off was $660 million. So the market erased roughly $100 of value for every $1 IBM came up short. That is not an earnings reaction. That is a genre of theater. And in the next few minutes, I want to tell you what the theater was actually about, because underneath the melodrama is a quiet move that changes what your company is worth, whether or not you own a single share of anything. Here is what I will give you: why this was a chess move and not just an investment story, how AI is repricing companies right now in a way that reaches a private business with no intention of selling, and the three things I would do this quarter if I were sitting in your chair. Start with what actually happened. IBM told investors that in the final weeks of June, its clients redirected their budgets towards servers, storage, and memory, grabbing scarce AI hardware ahead of price increases, and away from software and consulting. IBM's own software growth slowed, consulting was flat, and infrastructure actually shrank. The market heard that and did not sell only IBM. It sold Salesforce, Workday, Adobe, ServiceNow, and Accenture right alongside it, on a single shared fear that AI spending is not new money layered on top of the budget. It is the same money moving to a different square on the board. And that is the tell that this is structural, not a one-day tantrum. Because the same week IBM fell, the companies on the other side of the trade raised their guidance. TSMC, which makes the chips, lifted its revenue growth outlook for the year to north of 40%. ASML, which makes the machines that make the chips, raised its full-year forecast for the second time this year. Money is not leaving technology. It is leaving one kind of technology company and arriving at another. When the entire supply chain moves the same direction in the same week, that is not noise. That is the pieces rearranging on the board. Here is the part that matters. The market has stopped paying for what it used to pay for. For 20 years, the most valuable software and services businesses sold one thing underneath everything else: human time. A seat is a person. A billable hour is a person. And AI is very good at doing the work that used to require the next seat and the next hour. So the industry is quietly repricing its own model. The analysts at IDC think 70% of software vendors will be off pure per seat pricing by 2028. Goldman Sachs has a name for where this goes: results as a service, which is a very polite way for the software industry to admit that selling you seats was always a stand-in for selling you outcomes, and the stand-in just stopped working. One bank looked at Salesforce and called it in writing an AI-driven structural reset. The median public software company now trades at about 3.5 times its revenue. 5 years ago, that number was closer to 18. That is not a dip. That is a re-rating. Now, let me be honest, because I'm not here to sell you a panic. There is a real counter-argument. Forrester expects companies to push about a quarter of their planned AI spending from this year into next as finance chiefs finally start demanding proof. Accenture's own chief executive blamed a good chunk of its bad quarter on deal timing in the Middle East, not on the robots. Some of this is a pacing correction, and anyone who tells you the precise shape of the next 18 months is guessing. But the direction the pieces are moving is not really in doubt. So here is the question I actually care about, the one the financial news will not answer for you. Does any of this touch what your company is worth? And if you run a mid-sized business, the answer is yes, in a way that is easy to miss, precisely because it never shows up on a stock ticker. The people who buy companies for a living have already changed their spreadsheets. One of the big four accounting firms put a name on it earlier this year: the AI gap discount. When a sophisticated buyer looks at your business and sees the gap between where AI could take your operations and where you actually are, they now underwrite the cost of closing that gap and subtract it straight out of your enterprise value. The same company that used to be worth a clean multiple is now worth that multiple minus the bill to make it AI ready. On the other side, businesses with real AI wired into the work and revenue that looks like outcomes instead of seats are commanding 15 to 25 times earnings, where the traditional version of that same business gets 8 to 12. The advisory firm Quorum sorts sellers into tiers, and the genuinely AI native ones fetch 10 to 20 times revenue. The catch is that they estimate only 3 or 4% of companies actually qualify. Everyone else is somewhere on the discount side of that line. And before you tell me this is a public market problem, here is the uncomfortable bridge. Private company valuations track the public ones, but only at one moment, the moment you transact. Lincoln International measured private company values in the first quarter of this year and found they fell a little over 2%, even as those same companies earned more. Earnings up, value down, purely because the multiple compressed and private deals get priced off the public anchor. So if you are running a private business with no plan to sell this year, let me say the true thing first. This week's stock market has essentially zero effect on your cash flow, your customers, or your Tuesday. Treat the headline as noise for your operating decisions. But the multiple you will get whenever you do transact, in 2 years or in 4, is being set by how AI ready or AI exposed your business looks today. And readiness is not a switch you flip. Clean proprietary data, AI genuinely built into how the work gets done, a position where the agents plug into you instead of replacing you. That takes years to build. You cannot cram for it. You cannot start being AI ready the week the banker shows up any more than you can start being healthy the morning of the physical. We talked recently about making defensible one-time cuts before a transaction to dress up a quality of earnings statement. This is the opposite kind of work. This is the slow kind that has to be real, and it has to start well before you need it. So what would I do this quarter? 3 things, and not one of them requires you to have an opinion on whether NVIDIA is overvalued. First, run a pay-twice audit before you approve a single new AI line item. The average company already uses only about half the software licenses it pays for. 95% of AI pilots, by MIT's count, produce no measurable profit impact. One company reportedly ran up a $500 million AI bill in a single month because nobody was watching the meter. So fund your AI out of things you are willing to name and cancel, not out of fresh budgets stacked on top of the waste you already have. Make every new AI project name the legacy line item it retires. AI with no offsetting cut should be a red flag, not a rounding error. Second, do not sign a long multi-year software deal in the middle of this realignment without protection. Your vendors know their seat model is under pressure, which is exactly why they are pushing early renewals, double-digit price increases, and AI features bundled in so tightly you cannot pull them back out. Start your renewals 6 to 9 months early, cap your increases, and turn off auto-renew, which is quietly the most expensive checkbox in your company. Third, read IBM's bad day as a forecast for your own inbox. The same reallocation that hit IBM will show up as pricing pressure from your own vendors this cycle. Do not be surprised by it. Plan the conversation now on your terms. Because here is the whole thing in one line. This was never really a story about IBM, and it was never only an investment story. AI is repricing the difference between companies that sell human time and companies that own outcomes and their own data. The market is doing that repricing in public painfully this quarter. It is doing the same thing to your company quietly, and it will hand you the invoice the day you go to sell. The good news is that the work that raises your multiple is the same work that makes your people faster on Monday morning. You do not have to choose between the two. That is the YPO Tech Network AI Brief for Wednesday, July 22nd. I'm Stephen Forte. If this was useful, send it to a fellow member. I'll be back Thursday with more. Until then, stay sharp.